Continuing from DSCR, we move on to the next factor which will affect the debt equity ratio of an organization or choice between debt and equity. So this factor is talking about return on investment. That means how much return we are expecting on the amount of money which we have invested. So it means that whenever we are investing a certain amount of money, we are expecting some return on that same amount of money. So when we have made an investment and if we are expecting higher return on that particular investment, that means definitely we are looking into the equity. So if we have higher ROI, definitely we will borrow from equity or we'll get the money from equity, because if we have higher ROI, our earning per share will increase. Earning per share depends on return on investment. If the return on investment of the company is higher, then automatically its earning per share will also be more. And on the other hand, if the ROI is less, that means if the return on investment is less, that means the earning per share will not be more, then in that case the company can go for debt, more of debt. Now the next one is the cost of debt. What is the cost of debt? See, we have the cost of debt is always the interest. So interest is the cost of debt. So whenever we talk about the cost of debt, if we can get funds or if we can get loan at a lower rate of interest, then automatically we will go for debt. But if we don't get the interest at a lower rate of interest, if we don't get the loan at a lower rate of interest, then we cannot opt for that loan. So we have to go for equity. So if the COD is less, we will go for debt. But if the COD is higher, we will go for equity. Next, we move into the next point, which is tax rate. Rate of tax affects the debt percentage. That means the return on the cost of debt, which we have just now studied, that is the interest, is always affected by the tax rate of the organization. If the tax rate is higher, then debt becomes cheaper. That's why we can borrow more money or we can take more loan, because interest is always calculated after reducing the tax. So if the tax rate is higher, then the interest rate goes down, and then in that case we can always borrow more money. But if the tax rate is less, then definitely as we are reducing, we are subtracting less amount of money, less tax, so the interest will be higher. If the interest is higher, then we have to go for equity, more of equity. Okay. Then the next one is cost of equity. Now cost of equity means what? Equity, the cost of equity is that if we have a high risk, if we are taking a high risk, then definitely we will expect a higher return. This is normal expectation by anybody. So if we have a high risk, if we are taking up a high risk, we will expect a higher return. So when we are taking more of debt, when we are borrowing more money, then the cost of equity is going up because the risk is going up. If there is more risk, we will expect high return. So the cost of equity is going up. If the cost of equity goes up, then the share price will fall down. Because if we are expecting a higher return, but we are not getting up to that limit, then definitely people will not invest in our organization. So the share price will go down if the return expectation is too high. But if we don't have this high risk, that means if we have lesser debt, in that case, the cost of equity will be less. The reason behind this is that because we are taking less debt. Less debt means less risk. Less risk if we are taking, then definitely the cost of equity will be less. If the cost of equity is less, the share price will be balanced by earning per share and other factors. Next one is flotation cost. What is the flotation cost? If the flotation cost is the cost of raising the equity share capital, that means by introducing prospectus, by issuing prospectus, by registering in the share market, several other processes are there for which lot of cost has to be spent. So that is the flotation cost. When the flotation cost is higher, that means if you have to spend lot of money to get into the equity market or to to get equity share, then in that case we will prefer debt. But if the flotation cost is less, that means if we invest less money and then also we can get the equity, then definitely we'll prefer equity. The next one is risk consideration. For any business, there are always two types of risk. One is financial risk and the other one is business risk. Financial risk means payment of interest and principal and dividend, etc. So the risk which is associated with the payment of interest, principal and dividend and other payments is financial risk. The risk which is associated with the operating of the business, that means during day-to-day operations there are certain risks which can take down, like machine failure, turnover of the environmental situations or political considerations, several things can happen. So those are the operating risks. Okay, so two types of risks are there, financial risk and business risk. Now this business risk happens on a day-to-day basis and this is the most dynamic part of it. So if the business risk changes, that means if the business risk is less, then the debt will be more. We can take more loans if the business risk is less. But if the business risk is more, we have to take less of debt. Now the next one is flexibility. Flexibility means borrowing, keeping the borrowing power. Borrowing power means every company has an upper limit of borrowing, or every company has an upper limit of taking loan. So when we are saying that we want to maintain the flexibility, we basically want to maintain our borrowing power. We basically want to be in such a situation when our borrowing power will be stored for the unforeseen future situation. That means in the days to come, if something goes wrong, then we can immediately borrow money. So keeping that in mind, if the flexibility, we want to keep the flexibility higher, then we will take less debt now. If we don't want to keep the flexibility higher, we are pretty sure about the upcoming situations, then we can take more debt now.